Hello and welcome to this episode of Shared Lunch, where we're going to focus on the Australian market off the back of the recent earnings season. We're also going to chat about what to look for when investing in small to medium-sized companies.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
My name's Sonia Williams. I'm the co-founder and co-CEO at Sharesies, and today I'm joined by the Sydney-based Michelle Lopez, Head of Australasian Equities and Portfolio Manager at Pi Funds. Welcome, Michelle.
Hi, Sonia.
Before we get started, I'd like to acknowledge the traditional custodians of the land, water and sky on which we come to you from today, the Gadigal people of the Eora Nation, and pay my respects to their elders past, present and emerging. So thanks heaps for joining us, Michelle. Before we get into it, chatting all things the ASX, can you tell us a bit about you and what does a day-to-day look like for you?
Yeah, sure. Well, firstly, thanks very much for having me on your podcast, Sonia. I'm always really happy to share a bit about the exciting world of investing and really what moves and shakes it. So as you mentioned, I'm based here in Sydney, and as the accent is probably given away, I am an Aussie. And by way of background, I joined Pi Funds early last year in 2023 as a portfolio manager and, as you mentioned, head of the Australasian equity team. And I brought with me probably 20 years of experience investing in equities, most recently as the head of Aussie equities at a large global fund manager, where I trained very much on the job as a fundamental analyst, and really lucky to have learnt from some incredibly well-respected and successful portfolio managers and fund managers in the region.
You know, markets are volatile of nature, and especially of late, where we've seen the ASX has been down in the recent days due to some concerns around the US growth. Did this have any bearing to the end of the earnings season in Australia?
Yes, so August, which we've just come out of, you would think was a pretty, benign month if you looked at the performance over the month, which was virtually flat. But it certainly had a lot of volatility. And to your point, Sonia, the first week of August, we had a 5% drawdown, which was quite brutal. And then it just recovered all of that as we sort of progressed through it. To your point, yes, the big driver was data coming out of the US, but as you would know, August is really all about earnings for us and companies reporting. So we saw a lot of big moves just on a stock-by-stock basis. And again, if I sort of think through and I consider the earnings outcomes, again, at a high level, it looked like it was quite evenly matched between companies that beat expectations and those that missed expectations. But again, looking underneath the surface, there was a lot of call-outs from the reporting season. The first and biggest trend that we saw, and this probably isn't going to be a surprise for most, was really around the cost of living pressures. And these remain persistent and widespread. So there are a number of companies referring to changed consumer behaviours in response to kind of household budget pressures. And this was across the board. So this was retailers, it was supermarkets, which you think are quite defensive. It was the utility players, it was travel. However, I would actually say that the consumer has shown great resilience. If you think about sort of where we've come from an interest rate perspective and inflation being really high. And in fact, we're starting to see signs that the trough in the consumer activity is or could be behind us. So that'd be the first one. The second one is margins. So interesting that EBITDA, which is earnings before interest, tax, depreciation and amortization, which is quite a common terminology in our market, the margins were revised lower for every single sector throughout August. And, one of the key drivers, obviously inflation, But in our view, again, looking forward, which is really important, is we feel that the margin should begin to recover from here. So we are seeing costs stabilise, and importantly, we're seeing labour supply improving. And then maybe the final one's balance sheets. So balance sheets are strong. So the Australian corporates have remained lowly geared, and they've shown actually very little appetite to lever up. As you would know, we're probably at an inflection point from a rates perspective in Australia. We're lagging probably New Zealand in that sense. So there is an expectation that cuts will come next year. And again, that's we'll see kind of where the balance sheets go from there. But it's meant that there's been a number of buybacks that companies have been able to do. The other thing I'd probably highlight from reporting season is more on the guidance and the outlook statements. And again, the one thing was where companies did provide guidance, it was very conservatively set. As I mentioned, the living and interest rate uncertainties. And that actually meant that downgrades outpaced upgrades if you look into the next fiscal year, so FY25. And on average, 46% of the companies had earnings downgrades, and that sort of versus 20% that had upgrades. So again, there was a skew to having revisions revised downwards, earnings revised downwards.
Yeah, and when you say the downgrades and upgrades, do you want to just explain that, what you mean by that?
Yeah, of course. So upgrades, it essentially means that the management provide guidance that is ahead of where market expectations are. So in our world, earnings really drives share prices. So having an understanding of where earnings are going. So an upgrade is now we think earnings are going to be higher next year than what we originally thought. And downgrades is the inverse of that. So we've had to revise earnings down in light of what management commentary has been.
And so were there any surprises or anything that struck you as surprising from the...
There's always surprises, Sonia. There's always surprises. And by surprises, the direct correlation here is just share price moves. So when we look at the beat versus miss ratio, a couple of things to call out. So from a sector perspective, we had healthcare, the highest rates of beats. And then we had energy and utilities as the highest rate of misses. But to your question on surprises, when I look at share price reactions, and in fact, I pulled out a report just before our meeting, and they actually gave some numbers around this, which I thought was quite interesting. This is a JP Morgan report. But as you'd expect, so if it met expectations, share price was benign and in line with market. If they beat consensus by more than 2%, that bucket of companies outperformed by 3%. So in a flat market, which was what we had in August, they were up 3% as a whole. The interesting part is the misses. So those companies that missed expectations by 2% or more, that group actually fell by 6%. And that skew to the downside is why you'll hear industry veterans saying all the time around reporting season that the goal is really to avoid the blow-ups because you can see that skew. Companies that exceeded by 2% were up 3%. Those that disappointed by 2% were down 6%.
Are there any particular industries that you're keeping your eye on over the next 6 months?
Yeah, I suppose I'd call out... I'd probably call out 3. Again, months is a very, very short time horizon for us, but let me just call something out and then I'll caveat all of it. But the first one would probably be infrastructure and construction. So we've got a really solid pipeline. It's actually 1.7 trillion worth of work for the next 7 years. And importantly, this continues to be replenished. So there's a real tailwind within that sector. And then if I can narrow it in more, construction in particular, there's 240,000 new homes that are required annually to achieve, government supply targets. We're well below that level from an approvals perspective. And this has been a problem now for a couple of years, but it's really coming to a head. We've got a chronic shortage in housing, and we need to see this addressed. So I think over the next 6 months, that's one that I'll be looking at closely. The second one's probably those consumer exposed sectors. So as I mentioned earlier, we are starting to see signs of a trough in consumer activity. We've had retailers come up with trading updates throughout sort of July and into August, and it's showing an improvement. Not a huge improvement, but at least it's positive. So again, we've got tax cuts that have started to filter through the economy, and we've got interest rate cuts coming next year. So I think that's going to be quite stimulatory for the consumer. And then finally, just real estate. With interest rates now sort of entering a new phase, I think that's going to look interesting from a valuation perspective. But as I mentioned, look, that's just kind of sectors, and importantly for us, we're bottom-up fundamental investors, and that means that we approach investing at the company level rather than kind of at a sector level.
And are there any big milestones or announcements that coming up that you think will impact the markets in any way?
Oh, there's always announcements. I mean, you just don't know what you're going to wake up to and sort of overnight moves. But I mean, I suppose the very near term ones that we're looking for, macro data out of the US is always important. Payrolls, which we've had just very recently. We're about to enter, or we're in the campaigning of the US elections. That could have quite an impact on our market from a policy setting perspective. The other big sort of announcements, or I suppose external factors, if you wanted to call it that, is just commodity prices. Just to be aware that our market is quite levered to commodity prices, for better or worse. But yeah, they represent a large part of our exports. So any data and announcements around China policy will have an impact. Will have an impact there as well.
Yeah. So that's a nice thread to follow there around, like, what are some of the external factors that impact the Australian market?
Right, yeah, so I suppose like most countries, Australia is absolutely intertwined with global markets. So we really can't say we sort of stand alone. So there's always going to be external factors. I mentioned commodities, that's a big one for us. If you think about, and the reason for that, if you think about the top three contributors to trade, so our biggest exports, they're iron ore, coal, and LNG. So again, really important, just the demand for those in particular. The other one I would probably call out, and this is again not just for Australia, but geopolitics can really impact sort of markets, and then the energy situation. So I try to desensitize sort of big words, and I don't think it's a crisis, so we'll call it the energy transition. But again, that's what's proving out, is that it's slower and it's harder than what maybe we had hoped for, and what government's policy had sort of factored in. And what we've also found out is it's most likely going to need gas. So we've had hydrogen as an example of a renewable source that we were trying to develop. Capital's been sort of pulled out, actually, one of the major ones, just because the returns are not there. So to stimulate that level. So that's the energy transition is another one that's playing out in our market.
So with the US election coming up, like, how does that factor into how your investing decisions?
Taking a step back, what do elections mean? It could potentially mean a change in policies. And the difficult part at this juncture is the Biden-Harris administration haven't got firm policies in place. I think the Trump JD Vance does have a bit more, and it's the one thing I would say is both parties are going to be very stimulatory. And this is typically quite positive for equity markets. If I think about the risks either one way or the other that we're considering, so renewables is a really topical policy, the Inflation Reduction Act, which was introduced by Biden, that stimulated a lot of investment into renewables, a lot of incentives into that part of the market. So a question mark around whether that remains under Trump. I would say it's very difficult to unwind something like that. Although it's a risk, I wouldn't say it's a hugely likely to happen. But I think in totality, we're not overly concerned one way or the other, what way it falls and lands. We're positioned, and we've positioned our portfolio such that there's no great risk either way. And in fact, we see it as a stimulatory type of response from both parties.
Like now kind of honing in on one of the funds that you offer, talking about managing the risk or how you look at creating those things. One of the interesting things about the PI High Growth Fund is that you look to a lot of small to medium listed companies. What do you define as small to medium? Like we've heard a lot of the big companies or the big industries. How do you define that?
Yeah, so there's probably two ways to look at it. Firstly, is just market cap, so the size of the business itself, and small, we just given our size at the moment, we really do need to be mindful of liquidity risk. So we kind of say from the small end of 200 million market cap all the way up to say 15 billion for a mid-size business. And we deliberately try to keep our investable universe as broad as we can and as deep as possible. We don't want to limit ourselves within that. So that's the first kind of categorization. It's by market cap, it's by size. The second way to look at it, which is probably industry practice, is around the indices that they're in. So we focus on the small ordinaries for small caps, which is anything from, if I think about size of companies, stock number 101. So X100 all the way down to the 300 mark. And then for mid caps, we look at everything outside of the X50. So the top 50 names, we tend to classify as large cap.
Is the way that you consider those different to how you would consider some of the larger companies? Like how you evaluate them?
Yeah, good question. I think, the approach to investing and what we call, our investment process is very consistent regardless of the size of the company. So the characteristics that we're looking for in the businesses, which again, we could probably do a whole nother podcast on that because it's I obviously live and breathe it and love it. So, but the characteristics themselves and the kind of questions that we're trying to solve for are consistent. The one thing I would say though, and the reason why we have a preference for the small and mid cap over the large cap is that potential for outperformance is a lot greater within the small and mid cap space. And there's a number of reasons for that. The first one's that they're there's much less research available on them. And that allows for sort of more mispricing opportunities. And it's also a much less efficient part of the market. So again, that potential for outperformance is there. The other thing I'd say around small caps is that the growth is typically stronger. So when you think about the companies, they're typically younger companies. They're at an earlier stage of development. So that growth trajectory is stronger. And then the final piece, which is probably missed a little bit, is merger and acquisition or IPO, so initial public offerings within our markets, they've been a constant tailwind for small and mid caps. And in fact, 95% of merger and acquisition targets, in terms of the number of deals, have been in companies that have got a market cap of less than US 50 bill. And the average premium that they get when they're bid for is, 30 to 40%. And that's created a really strong tailwind within that part of the market. So that's the differences I'd call out between sort of the large versus small and mid. But what we're looking for in a company is it would be consistently applied in the large cap as well.
And are there any particular companies that you're keeping an eye on at the moment?
Or maybe if I think about kind of what I mentioned previously around sectors to keep a lookout. So the consumer is one. There's an interesting company that we are invested in called ARB Corp, which manufacture and sell full drive accessories, both domestically and internationally. And there's really three parts to that business. There's the Australian aftermarket, which is their highest quality earnings stream. Secondly is the exports. So they sell into a number of different regions, New Zealand, the US, UK, EMEA. But the US export market is the part of the business that we think that the broader investment community is underappreciating and isn't properly being priced in. Our view is that they're at an inflection point, having seen sales go backwards for a couple of years in the US. They've turned positive and momentum's building, and they've actually invested quite a bit of capital there, and early conversations that we're having across different parties over there has been really constructive. And the other big thing is that they've won contracts with Toyota over in the US to factory fit their accessories. So I think this is an interesting company. It's still got founder ownership in it. It's got a pristine balance sheet with net cash on it. And it's got quite a clear runway for growth, particularly in the UK. So that's one I'd probably call out from a consumer perspective. That's in the small cap part of the market. Maybe in the mid cap, just thinking about results. So a really interesting one was actually WiseTech. So WiseTech, they're a leading developer and provider of software solutions into the logistics industry. In fact, one of New Zealand's, one of their great companies, which is Mainfreight, they're one of their key customers that use WiseTech and the solutions. But what was particularly interesting at this point of time, if they've just announced 3 new major products. One of them is a new generation of their existing, but the other 2 are white space products, which means it's all incremental earnings from those 2. And they're really solving a big problem and a costly issue that these logistic companies face. So again, I think it's going to be really beneficial for the earnings of WiseTech, but also for the customers that take it up. So that's another one. Again, the founder, I think, still owns 40% of the business, very strong balance sheet, a very long runway of 30 to 40% earnings growth over the next few years. So again, that's one that we think has got sort of long-term duration in the portfolio.
Some would say that the ASX provides more retail or better retail opportunities than the NZX currently. What do you think about this, or what do you think the main points of difference are?
Yeah, I think it just comes back to the depth of opportunities, really. There's just much more or many more stocks in Australia. There's a greater diversity of companies and industries available for us to invest in. New Zealand traditionally has been quite a high yield market, dominated by infrastructure and property names. And whilst there's actually a very strong concentration in the Australian large cap part of the market, so if you think banks, the big miners, a couple of supermarkets, if you strip that out, and again, maybe one of the reasons we tend to focus on small and mid cap, it offers a real diversity of businesses. And in fact, there's some real global leaders amongst that pack as well. So I suppose if I had to just really zoom out, it would be that there's just more stocks, greater depth of opportunities. Having said that, though, I think for the first time, the first time since I joined Pi 18 months ago, we're seriously looking at some New Zealand investments. That there are companies over there with very solid fundamentals, and importantly, share prices at the moment are probably factoring in continued kind of challenges and doom and gloom that the NZ market has really muddled through. And that presents some really good buying opportunities, right? So we're absolutely not dismissing New Zealand, and I think probably this is the time to start really kicking the tyres.
What kind of opportunities do you see?
There's two that we're sort of really down. We're doing quite detailed work on. One of them is actually in the logistics company, and again, what we like about this investment opportunity in particular is, yes, there's a large proportion of their earnings tied and pinned to the New Zealand economy, which we think is at an inflection point. But they've also, so that's the near-term sort of thesis and earnings driver, but then they've also got optionality and upside through through the US side of the business. So again, that's one. The other one is more in the property side of things. So again, with interest rates being quite high in New Zealand up until recently, and also the valuation of a lot of these property companies have come down and are trading at book value or well below book value. And this particular company's got a really strong pipeline of development sort of in the aged care space. So again, that's just a couple of examples that we're looking at that the valuation we think underpins quite a bit of upside from here.
What's one company, if it springs to mind, that you wish you invested in 10 years ago and why?
You know what? This one's easy for me because I also wish I invested in a PA. You know what? For me, it's Pro Medicus. Pro Medicus is it's a healthcare IT company specialising in radiology imaging software. And I have been a shareholder from a professional capacity, and it's in the funds today. But the stock was $1 10 years ago. I think it was $1. I'll have to check that. I think it was $1, close to $1. It's 150 today. So, that type of return, I'm not sure there are many, if any, other companies. And importantly, this was not just a one-hit wonder. It wasn't just that they, hit drill results in a gold mine and cracked it. This has been a really consistent compounder. And, it's a super high-quality business. It's by high quality, the revenues are recurring. So it's locked in revenues, 95% locked in through very long-term contracts. The profit margins are industry leading. They've got a globally leading product. Their customers and their clients are top-tier academic universities in the US. So, think Mayo. And importantly, a really solid earnings trajectory. Even as we stand here today, they've got a very clear pathway to be generating 30% per annum for the next 3, probably 10 years. And the reason is their penetration is still very low. They're 7% penetrated, and they've got new adjacencies. So I mentioned radiology. They're getting into cardiology. They're just been accredited the highest level of security for the US Department of Defense. So there's all these other growth avenues.
And do you think, like the power of hindsight, do you think there would have been signs 10 years ago that would have what would have been the signs 10 years ago that it was going to end up on that path?
Yeah, I probably started investing in this company 6 years ago. 6 or 7 years ago, I would say. I think this is a really good example of a company that when you see these really solid fundamentals and you can see a global market and they're winning off the major incumbent companies like Philips and Siemens, it's clearly gaining traction, and you've got to listen, and the repeatability of it. So if they're able to do that consistently for 3-4 years, I think sometimes valuation's been the real blocking reason people haven't been invested in it. But I think you need to approach a company like this from a different lens, from a valuation perspective. Yeah.
Well, thanks heaps for joining us, Michelle, and sharing your insights with us.
No, it's been a pleasure. Been an absolute pleasure. So thanks for having me.
Awesome. And thanks everyone for tuning in. You can watch this Shared Lunch episode on YouTube or follow the podcast on your favourite podcast app. Leave us a rating and a comment about what you'd like to hear about next. Thanks everyone, and goodbye.